Well, this is fundamental accounting principles, and today I like to talk about analyzing and recording transactions. Okay, so here let's start this one. Analyzing and recording process. So we have four steps. One is analyze each transaction and even from source document. Two, record relevant transaction and even in a journal. 3. Post journal information to a ledger account. 4. Prepare and analyze their balance. So what is source documents? Source document identify and describe transaction and even entering the accounting process. So what are these? Source document we have sale ticket, checks, purchase order, bills from suppliers, employee earning record, and bank statement. These are the source documents. And the account and it analysis. What is account? Account is a record of increase and decreases in a specific asset, liability, equity, revenue, and expense item. So account also classify into three general categories based on accounting equation: asset, liability, or equity. So what asset? Assets are resources owned or controlled by a company and that have expected future benefit. So we have asset accounts such as cash, account receivable, no receivables, prepaid account, supplies, equipment, building, and land. So let's talk about them one by one. First, cash account. Cash account reflect company cash balance and include money and any medium of exchange such as coin, checks, money orders, and checking account balance. How about account receivables? Account receivable held by a seller and refer to promise of payment from customer to sellers. So these transactions are often called credit sales, sale on account, or on credit. No receivables, you can call promissory note. It's a written promise of another entity to pay a definite sum of money on a specified future date to the holder of the note. Prepaid account, sometimes you call prepaid expense, are assets that represent prepayment of future expense, not current expense, and we have prepaid insurance, prepaid rent, and prepaid service, such as club membership. Supplies also assets, and we have two types of supply: office supply, store supplies. So office supply we have stationeries, paper, toner, and pens. In store supply we have packaging materials, plastic and paper bags, gift box and carton, and also cleaning materials. Equipment. Equipment is a long-term asset, and equipment is used and get worn down. It costs gradually reported as expense, and that expense we call depreciation expense. We have two types of equipment. We have office equipment and store equipment. So office equipment exactly physically is computer, printer, desk, chairs, and cells. And store equipment we have here counter, showcase, ladder, hose, and car register. Building. We refer to store, office, warehouse, and factory, also called also considered as asset, because they provide expected value, future benefit to those who control or own them. And the last one is land. The cost of land owned by a business is recorded in a land account. Number 2 is liability account. Liability are claimed by creditor against asset, which means they are obligation to transfer asset to provide products or service to other, including account payable, note payable, unearned revenue, accrued liability. So first, account payable. refer to overall or implied promise to pay later, which usually arise from purchase of merchandise. Payable can also arise from purchase of supply, equipment, and service. Notes payables we refer to a formal promise, usually denoted by signing a promissory note to pay a future amount. Unearned revenues are also classified as a liability, and that is settled in the future when a company delivers its product or service. Example of unearned revenue we have here: magazines subscription, and sale of gift certificate, and season ticket sale by sport team. Accrued liability are amount owed that are not yet paid. Example of accrued liability is we have wage payable, tax payable, and interest payable. The owner claim, so now it's the last one is equity account, and the owner claim on a company asset is called equity or owner equity. Equity is also called net asset equity, and equity is impacted by 4 types of account. We have owner capital, owner withdrawal, revenue, and expense. So owner investment in a company we consider as account title is C Taylor capital, and owner withdraw asset for personal use, and we will put in account title as C Taylor withdrawals. So revenue increase equity. Revenue result from product or service provided to customer, and we have example here for revenue: sale, commission earned, professional fee earned, revenue, and interest revenue. Expense decrease equity and result from asset and service used in a company operation. So we have advertising expense, store supply expense, office area expense, office supply expense, rent expense, utility expense, and insurance expense. Now let's talking about ledger and a chart account. So what is a ledger? Ledger is a collection of all accounts for an information system. A company's size and diversity of operation affect the number of accounts needed. How about chart account? Chart account is a list of all accounts and include an identifying number of each account. So here we have account number and account name. So here the account number we can put, if the number starting with number 1, it represents of asset account. Number 2 is a liability account. Number 3 is security account. Number 4 is revenue account, and number 5, in here we don't have number 5, but if we have number 5, we consider as a cost of sale or cost of goods sold. And number 6, 7, 8, 9 is expense account. Debit and credits. A T account represents a ledger account, and it tool used to understand the effect of one or more transactions. So this T account, you can say letter T. The left side is debit, the right side is credit. Okay. So double entry accounting requires that for each transaction, first, at least 2 accounts are involved, with at least 1 debit and 1 credit. The total amount debited must equal the total amount credited. Accounting equation must not be violated. So let's talking about asset, about the increase and decrease, liability increase and decrease, and equity increase and decrease. So asset, all asset account we have here increase at debit, in debit, and liability increase credit, equity increase credit. Okay, so we can say normal balance of asset account is in credit, is in debit, and a liability in normal balance of liability credit, and equity is normal balance is credit. And the normal balance of account owner capital is credit, it means increase in credit, and normal balance of withdrawal increase debit, and revenue credit, expense is debit. So before we journal the transaction, we need to know the format of the journal entries. Or you can say general journals. Here, first you need to put the date, and number 2, title of account, cash and capital, and number 3 is put the dollar amount of debit and credit, and number 4 you put the explanation of the journals. It's the format of the journal entries. After that, we need to post from journal to general ledgers. So we need to know the format of general ledger also. The general ledger, number 1, we need to put identify the debit account in ledgers, and number 2, enter the date, and number 3, we enter the amount and description, and number 4, we enter the journal reference, and number 5, we compute the balance. Okay, number 6, enter the ledger reference, and then now we can start to analyzing transactions by using a journal, by recording in a journal entry. Here, owner invested 30,000 in fast forward on December 1. So as if we do in a accounting equation, asset equal liability plus equity. So we put 30,000 cash under cash and 30,000 under capital. Then we can start. So owner invested 30,000. So we have cash in the company. So cash is asset account. So cash increase debit. So this debit represent a debit, and this one represent a credit. So cash increase 30,000 and capital increase 30,000. Capital is equity account increase 30,000. So we can do two separated T account for cash and for capital. Number 2, fast forward purchase supplies by paying 2,500 cash. So we have cash and supplies, 2 account, cash and supply, and cash and supply is asset account. So supply increased 2,500 and cash decreased 2,500. So we put here debit supply, credit cash 2,500. Okay, and another one is fast forward purchase equipment by paying 26,000 cash. So we have 2 types of asset account. One is cash and another one is equipment. And decrease cash 26,000 and increase equipment 26,000. So debit equipment. So in a journal entry, we need to record account in debit first, and then we start to record the following account, credit cash. Okay. And fast forward purchase 7,100 of supply on credit. So we purchase on credit. So we have supply 7,100, but we have another account, is account payable increase in liability 7,100. So we debit supply 7,100 and credit account payable 7,100. Okay, now fast forward provide a consulting service and immediately collect 4,200 cash. This one we have here. We have cash from consulting revenue 4,200 and increased revenue is 4,200 also. So we debit cash 4,200 and credit consulting revenue 4,200. And this one 101 403 we represent of here the account numbers. Now the last step of accounting process is here. We need to do a trial balance report, and here is the trial balance lists all account balance in a general ledgers. If the books are in balance, the total debit will equal total credit. Okay, so we have the way to prepare a trial balance report. First, we need to start with account, asset account, and then we start with liability, equity, revenue, and then expense. This we need to put it in order to prepare trial balance report. So total debit and total credit together must be equal. Okay, thank you for watching our video, and please like and subscribe my channel. Thank you.